What if I told you Australia's famous $18,200 tax-free threshold doesn't tell the full story? For many Australian resident taxpayers, the point where income tax effectively reaches zero can actually be as high as $22,575. But here's the dangerous part: misunderstand how that number works, and you could waste money on deductions you don't need, claim expenses the ATO may reject, or move thousands of dollars into super just to chase a $0 personal tax bill. In this video, we're going to uncover the hidden calculation that turns $18,200 into $22,575, the truth about so-called receipt-free deductions, and the superannuation trap that can make paying zero tax far less impressive than it sounds. The final example could be worth tens of thousands of dollars, so stay with me. Before we begin, this video contains general information, not personal financial or tax advice. These examples use Australian resident individual tax rates applying from July 1st, 2024, and the maximum $700 low-income tax offset. Tax and super rules can change, so always confirm the rules for the relevant financial year with the ATO or a registered tax professional. Ask almost any Australian how much they can earn tax-free, and they'll probably give you the same answer: $18,200. That figure was introduced back in the 2012-13 financial year and has remained unchanged for more than a decade. Since then, rent has surged, groceries have become more expensive, petrol prices have climbed, and the overall cost of living has moved dramatically. Yet the statutory tax-free threshold remains frozen at $18,200. But behind that headline number sits another mechanism, one that quietly changes the final result. It's called the Low Income Tax Offset, or LITO. And this is where the story gets interesting. A tax deduction and a tax offset are not the same thing. A deduction reduces your taxable income. For example, if you earn $50,000 and claim a legitimate $1,000 deduction, you're generally taxed as though you earned $49,000. You don't receive the full $1,000 back. You only save the tax that would have applied to that $1,000. An offset works differently. It reduces the actual income tax you owe dollar for dollar. Think of a deduction as making the bill slightly smaller. An offset is a credit applied directly to the bill itself. The maximum LITO is $700. If your taxable income is $37,500 or less, you may receive the full amount automatically when your tax return is assessed. You don't need to apply for it separately. And that $700 creates Australia's hidden zero income tax point. Here's the calculation. Under the tax rates applying from July 1st, 2024, every dollar of taxable income between $18,200 and $45,000 is taxed at 16%. So how much additional income generates exactly $700 in tax? Divide $700 by 0.16. The answer is $4,375. Now add that amount to the statutory threshold. $18,200 plus $4,375 equals $22,575. That is the effective zero income tax point under these assumptions. At a taxable income of exactly $22,575, the amount above $18,200 is $4,375, taxed at 16%. That produces an income tax bill of exactly $700. The ATO then applies the maximum $700 LITO, reducing the final income tax bill to zero. There's no secret form, special request, or hidden application. MyTax or your registered tax agent generally calculates the offset automatically. But there's an important distinction. The legal tax-free threshold is still $18,200. The $22,575 figure is an effective zero income tax point created by LITO. It applies to taxable income, not necessarily your gross salary, and assumes you're an eligible Australian resident taxpayer using the standard rates. LITO also cannot create a cash refund by itself. It can reduce your income tax to zero, but any unused portion isn't paid to you as free money. Other obligations, including help repayments, the Medicare levy, and other liabilities, may also need to be considered depending on your circumstances. Now we need to deal with one of the most dangerous tax rumours circulating online. You may have heard that Australians can claim a flat $1,000 work-related deduction without receipts. Don't automatically put that claim into your next tax return. A future standard deduction may be announced or proposed, but that doesn't mean it applies to the return you're lodging now. You must always check the rules applying to the specific financial year. Under the existing substantiation rules, the commonly misunderstood figure is $300. If your total work-related expense claim is $300 or less, you generally may not need written evidence such as receipts. But here's the catch. That does not make it a free $300 deduction. You must still have spent the money. The expense must be connected to earning your income. You must not have been reimbursed by your employer. And you must be able to explain how you calculated the claim. If your total work-related expense claim exceeds $300, you'll generally need written evidence for the entire amount, not just the portion above $300. There are specific exceptions for certain expense categories, but the $300 rule itself is an evidence concession. It isn't free money, and it doesn't guarantee a refund. Claiming expenses you never incurred can result in the deduction being denied, interest being charged, and penalties being applied. Let's see how this works in the real world. Meet Sarah. Sarah is a 22-year-old university student living in Adelaide. She works part-time in a retail store and earns $24,000 during the financial year. Sarah has always believed that every dollar above $18,200 is fully exposed to tax, so she calculates $24,000 minus $18,200, leaving $5,800. At 16%, that produces $928 in income tax before applying LITO. Sarah panics. She starts thinking about buying a new laptop she doesn't really need, along with expensive boots she hopes to describe as work clothing. But that could be a costly mistake. Conventional clothing, including ordinary shoes and boots, is generally not deductible simply because you wear it to work. A laptop must genuinely be used for work, the private use portion must be excluded, and depending on its cost and circumstances, the deduction may need to be claimed over time. Most importantly, spending $1 just to save a fraction of that dollar in tax doesn't make you wealthier. Now let's apply LITO. Sarah's initial income tax is $928. Her maximum $700 LITO reduces that bill to just $228, assuming she has no other relevant liabilities. To bring her taxable income down from $24,000 to the effective zero income tax point of $22,575, Sarah needs $1,425 in legitimate deductions. And the key word is legitimate. Suppose Sarah has already incurred and properly recorded $300 in deductible union fees, $500 for eligible self-education directly related to her current employment, $225 in eligible uniform and laundry expenses, and $400 in donations to deductible gift recipients. That totals exactly $1,425. Her taxable income falls to $22,575. Her calculated income tax is $700. LITO wipes out that $700. Her final income tax becomes zero. If her employer withheld PAYG tax during the year, that withholding may then be refunded, subject to any other debts or liabilities. Sarah didn't manufacture expenses. She didn't panic buy a laptop. And she didn't waste hundreds of dollars to chase a small tax reduction. She simply claimed genuine expenses she had already incurred. That is the difference between tax planning and tax panic. Sarah's mistake could have cost her hundreds of dollars. But Michael's mistake could cost tens of thousands. Michael is 62 and has recently retired. He sells an investment property he has owned for almost 2 decades. After accounting for the property's cost base and other relevant adjustments, assume his discountable capital gain before the CGT discount is $386,400. Because he held the property for more than 12 months and qualifies for the standard 50% CGT discount, his taxable net capital gain becomes $193,200. Assume Michael has no other taxable income, no additional capital losses, and no other relevant adjustments. If he does nothing, his estimated income tax under the post, July 1st, 2024 rates is approximately $53,078. Add the standard 2% Medicare levy of approximately $3,864, and his total reaches about $56,942. This simplified calculation excludes any Medicare levy surcharge or other personal adjustments. Michael now discovers a powerful strategy. Carry forward concessional super contributions. If Michael's total superannuation balance was less than $500,000 on June 30th of the previous financial year, he may be able to use unused concessional cap amounts from the previous 5 financial years, but there's no universal carry forward amount. The exact figure depends on his previous concessional contributions, the annual caps applying in each year, whether older unused amounts have expired, his total superannuation balance, and his personal eligibility to claim a deduction. That is why Michael must check the official amount through the ATO's linked service in myGov. For this example, assume the ATO confirms that Michael has at least $148,200 of available concessional cap space. Michael considers making a personal super contribution and claiming the full amount as a tax deduction. That would reduce his taxable income from $193,200 to exactly $45,000. And this is where the numbers become powerful. At $45,000, Michael's basic income tax is $4,288. His partial LITO is $325. That reduces his income tax to $3,963. Add approximately $900 in Medicare levy, and his personal tax becomes roughly $4,863. But the contribution itself is not tax-free. His super fund will generally pay 15% contributions tax on the $148,200. That equals $22,230. Michael's combined tax position is now approximately $4,863 in personal income tax and Medicare levy, plus $22,230 in contributions tax inside super. That produces a combined total of approximately $27,093. Compared with doing nothing and paying approximately $56,942, Michael's estimated tax reduction is $29,849. That is serious money. But why does the strategy work so well? The answer is tax arbitrage. Tax arbitrage is the difference between the personal tax rate Michael avoids outside super and the contributions tax paid inside super. For the portion of Michael's taxable income above $190,000, his marginal personal tax rate is 45%. Add the 2% Medicare levy, and the combined rate is 47%. Moving those dollars into super may replace a potential 47% personal tax rate with a nominal 15% contributions tax. That's a potential difference of 32 percentage points. For income between $135,000 and $190,000, the combined personal rate is approximately 39%. Compared with 15% inside super, the difference is 24 percentage points. For income between $45,000 and $135,000, the combined personal rate is approximately 32%. Compared with the 15% contributions tax, the difference is 17 percentage points. That is where the strongest immediate tax benefit sits. But once Michael's taxable income falls below $45,000, the benefit begins to shrink, and this is where chasing a $0 personal tax bill can become a trap. Michael could continue contributing until his taxable income falls below $22,575. His personal income tax could then reach zero. On paper, that sounds like victory. But the money entering super may still be taxed at 15%. Between $37,500 and $45,000, the interaction between the 16% tax rate, the Medicare levy, and the LITO phase-out may still produce a worthwhile benefit. Below that level, however, the benefit generally becomes much smaller, and the Medicare levy's low-income rules make the calculation more complicated. In parts of the lowest bracket, Michael may be replacing a 16% personal tax rate with a 15% super contributions rate. That's potentially a difference of only 1 percentage point before considering the Medicare levy and other factors. And once Michael's taxable income has already reached the effective zero income tax point, an additional deductible contribution may save no further personal income tax while still attracting 15% tax inside super. He could end up volunteering to pay tax inside super simply to make the personal tax bill displayed on his return look better. That doesn't mean contributing below $45,000 is always wrong. Michael may still have valid reasons to do it, such as building his retirement savings, using an unused cap before it expires, reducing certain personal tax liabilities, managing future investment income, or benefiting from the long-term tax environment inside super. But it isn't automatically the best move. Michael must compare the personal tax saved, the contributions tax paid when he can access the money, whether any unused cap amounts are about to expire, his future tax position, his investment strategy, and his retirement objectives. The goal shouldn't be to produce the prettiest tax return. The goal should be to create the strongest overall financial outcome. A $0 personal tax bill is nothing more than a vanity metric if achieving it leaves you with less flexibility or less money overall. Even if Michael's strategy is financially sound, one paperwork mistake could cause the deduction to be rejected. First, Michael must log into myGov, open the ATO-linked service, and check his official carry-forward concessional contribution information. He must also confirm that his total superannuation balance was below $500,000 on the previous 30th of June. He should never rely solely on memory, an old statement, or a personal spreadsheet. Next, Michael must confirm his exact available concessional cap, whether any age or work test requirements affect him, whether his super fund accepts personal contributions, whether additional tax rules such as Division 293 could apply, and whether any unused cap amounts are close to expiring. He must then make the contribution early enough for the super fund to receive it before the deadline. A contribution generally counts when the fund receives the money, not when Michael presses the transfer button in his banking app. Super funds may also have their own processing cutoff dates. Waiting until June 30th is extremely risky. Michael should follow his fund's instructions and transfer the money well before its advertised deadline. After the fund receives the contribution, Michael must submit a valid notice of intent to claim or vary a deduction for personal super contributions. That notice must be sent to the super fund. Simply mentioning the contribution to his accountant at tax time isn't enough. Timing is critical, particularly if Michael plans to roll over the money, withdraw it, or begin a super pension. Finally, Michael must wait for written acknowledgement from the super fund before claiming the deduction in his tax return. Lodging the return first can cause the deduction to be denied or create a difficult amendment process. With super contributions, getting the strategy right is only half the job. The paperwork must also be right. So, what's the real lesson? Australia's statutory tax-free threshold is still $18,200. But when the maximum $700 low-income tax offset is applied, the effective zero income tax point can become $22,575. The $300 work expense rule is not free money. It is generally a written evidence concession, and you must still have genuinely incurred the expense. And concessional super contributions are not tax-free. They normally attract 15% tax inside the fund, with additional tax potentially applying in some circumstances. The smartest tax strategy isn't about blindly chasing zero. It's about understanding what happens to every dollar before the deduction, after the offset, and inside the super fund. Because the number that looks best on your tax return isn't always the number that leaves the most money in your pocket. If this video changed how you see Australia's tax-free threshold, hit the like button and subscribe. And before you lodge your next return, remember these three numbers: $18,200, $700, and $22,575. The first is the headline, the second changes the calculation, and the third is the number most Australians were never properly shown.